All right, welcome back in the deep dive. And look, if you were watching the screens yesterday, specifically the precious metals sector, you probably feel like you just stepped off the world's most dangerous roller coaster. I mean, without a safety bar.
Oh, it was absolute chaos. And honestly, chaos might be too polite a word for it. It was a complete market dislocation.
We were talking about silver.
Mm.
Yesterday, Thursday, January 29th, we saw the price crash $15
Mm.
in just 30 minutes.
Yeah.
It went from $121 down to $106 per ounce. That is a 15% drop in half an hour.
Which, I mean, if we're being technical, that's a liquidation event. In any normal market, a 15% drop like that isn't just a bad day.
Nah.
It's a catastrophe. It usually means something has fundamentally broken.
And yet, and this is the twist that we're going to spend our time unpacking today,
Yeah.
despite that massive crash, despite the panic, silver turned green on the day. It clawed all the way back up to $117. It didn't just survive the crash, it erased it.
It's impossible behavior, or, at least according to all the textbooks in the last, 40 years of trading history, it should be impossible.
So our mission today is to figure out what exactly just happened. We need to understand why a $40 trillion asset class is suddenly moving with the volatility of a meme coin.
Yeah.
And we're going to unpack this massive widening disconnect, this gap that is scaring a lot of institutional folks between the paper price here in the West and the physical price over in the East.
And that disconnect really is the key. I mean, we aren't just looking at volatility, we're looking at the mechanics of the Western pricing system breaking down in real time.
Okay, so let's start with that. The old playbook versus what we saw yesterday. You said this kind of recovery should be impossible. Walk us through why. In the old world, say, just 2 years ago, what happens after a flash crash like that?
Well, historically, a smash down like that is it's a death sentence for the price action, at least in the short term. When you drop $15 in minutes, you trigger these massive sell stops.
Right, and just to clarify for everyone, sell stops are those automatic orders to sell if the price hits a certain low, right?
Yeah.
To stop the bleeding.
Exactly. It's an automated safety net. But when everyone's safety net goes off at once, it just creates a cascade. It scares all the momentum traders out of the market. In the old normal, a move like that breaks the psychological back of a bull market. You'd expect days, maybe weeks, of follow-up selling as people, lick their wounds.
So the chart looks broken and everybody just walks away.
Right. A big paper dump on the futures market would short-circuit the whole rally. That's just how the market worked for decades. The paper price dictated everything.
But yesterday proves it's dead.
Completely dead.
Yeah.
The paper manipulation machine, and I don't use that term lightly, I mean the high-frequency trading of derivatives, they tried to dump everything.
They threw the kitchen sink at it.
They did, and the physical market just absorbed it and kept going.
Let's just look at the timeline, because it really shows you how violent this move was. At 9:15 a.m. yesterday, silver's at $121. Very strong new highs.
It was looking parabolic.
Then the floor just falls out. By 10:29 a.m., so just over an hour later, silver's at 106.
And that's the crash. That's where all the leverage gets completely wiped out.
But by 4:00 p.m., the market closed. Silver's back at $117.
To give you some perspective on how wild that is, I mean, think back to the period between 2020 and 2024. For 4 years, silver would barely move 50 cents a day. A big day was $1.
Yeah.
Now, we're seeing $15 swings in a single session.
It's like the volatility knob just broke off. But here's the interesting thing about when this is all happening. This isn't random, right? There's a geographical pattern to it.
There is. And this is what we're calling the tale of two markets. Nearly all the selling, the big drops, are happening during U.S. market hours. The U.S. wakes up, they dump digital derivatives and paper promises, and the price drops. Then the rest of the world wakes up, specifically Asia, and they start buying the physical metal, driving the price right back up.
So it's a tug of war. One side is using paper leverage, and the other side is literally taking delivery of actual physical bars.
And right now, the physical side is winning, hands down.
This brings us to what I think is the most mind-blowing data point we have, the Shanghai spread. We talk about arbitrage sometimes, buying low here, selling high there, but this is on another level.
It really is. We crunched the numbers coming out of the Shanghai Futures Exchange. Right now, silver in Shanghai is trading at about 31,620 yuan per kilo.
Okay, help us out with the conversion. What does that actually mean in U.S. dollars per ounce?
When you do all the math, the Forex conversion, the weight conversion, it comes out to roughly $141.42 per ounce.
Wait, hold on. $141.
Yes. 141.
But the Western spot price, the price we see on the COMEX in New York, is hovering around, what, 116, 117?
Correct.
That's a $25 difference.
A $25 per ounce premium. Just think about that for a second. If you have an ounce of silver in New York, it's worth $25 less than that exact same ounce of silver in Shanghai.
I have to play devil's advocate here, though. Aren't markets supposed to be efficient? If there's a $25 profit just waiting to be made by moving metal from New York to Shanghai, why isn't that gap closing?
That is the billion-dollar question. In a functioning market, arbitrage closes that gap, instantly. The fact that it isn't closing tells you we're in a monetary regime change. It tells you the friction is too high, physical friction. You can't just email a bar of silver to China. You have to secure it, insure it, fly it. But more importantly, it suggests that the metal is being vacuumed out of the West, but the Western paper markets haven't quite realized they're running on empty yet.
So the spread keeps growing.
It's growing by $2 to $5 a day. It's unsustainable.
Because eventually you run out of metal in the West to send over.
Exactly. You can't have a global asset trade at two wildly different prices forever. Either the Western price has to skyrocket to meet Shanghai's, or the Western pricing system, the COMEX, the LBMA, it just loses all legitimacy.
It feels like we're watching a slow-motion bank run, but on a global scale. The East is calling the West's bluff.
And it's not even that slow motion anymore.
Well, speaking of things breaking, let's move from the charts to the actual plumbing. Because the charts are just lines on a screen, but the physical infrastructure of the market seems to be seizing up. We're hearing reports that U.S. refineries are locked up. What does that mean exactly?
It means they are physically backed up. Refineries have a limit, a throughput limit. They can only melt and process so much metal per day. And the volatility, the sheer volume of physical demand is overwhelming their capacity to refine and mint bars and coins.
So even if you have the raw material, you can't turn it into an investment product fast enough.
Exactly. And that bottleneck trickles right down to the retail level. We were hearing that local coin shops actually had to halt purchases midweek.
They stopped buying from customers.
Yes. Can you imagine? You walk into a shop to sell your silver and cash in on these high prices, and they say, sorry, we can't take it.
Why?
They ran out of cash, capital constraints, and the volatility was so high they couldn't risk holding the metal for even a few hours.
Because if it drops $15 while it's in their safe, they lose their entire margin.
Precisely. The system it paused, it blinked.
That's wild. But there is an even bigger piece of news on the supply chain. This is essentially breaking news.
This is critical. We have information indicating that a major government mint, one of the big ones, responsible for sovereign coins, is shutting down silver sales.
When?
We think within the next 24 hours.
A government mint stopping sales.
Yeah.
It usually only happens when they physically run out of the blank coins, right? The planchettes.
Or when they simply cannot price the product because the market is moving too fast. Look at the sequence here. Refineries get jammed up. Then local coin shops halt trading. Now the government mints are shutting off the tap. The system is breaking down in order.
It really frames yesterday's recovery in a new light. It wasn't just buying the dip. It was the physical market literally asserting its dominance over a paper market that's losing control.
The plumbing is clogged and the pressure is building up fast.
So let's go back to the crash for a moment. We know the price recovered, which is the big story, but it did crash first. Why? I mean, things don't just drop 15% for no reason.
No, they don't. And when we analyzed the data, we found a perfect storm. It wasn't just one thing. It was 5 specific factors that all hit at the exact same time.
Okay, let's run through them. Factor number 1.
Leverage. This is the classic culprit. You had traders piled into futures contracts with 50 to 1, maybe even 100 to 1 leverage.
Meaning, for every dollar of their own money, they're borrowing $99 to bet on the price.
Right. And leverage is great on the way up, but it's absolutely lethal on the way down. The price dips even a little bit, they get margin called, and their positions are automatically liquidated. That selling triggers more selling.
The cascade. Okay, factor number 2.
Simple profit taking. I mean, we have to be realistic here. Gold is up 160% in 2 years. Silver's up nearly 380%.
That is a parabolic run.
It is. So naturally, people are taking some chips off the table. They're locking in gains. That creates selling pressure.
Makes sense. Factor number 3.
This one is interesting. It actually came from outside the metals market. It was Microsoft.
Microsoft. I saw they took a hit, but how does a tech stock crash silver?
It's all about liquidity.
Yeah.
Microsoft dropped 11% yesterday on some disappointing cloud and AI numbers. When a giant like that falls, it drags down the whole market, the NASDAQ, the S&P.
It creates a risk-off mood.
Exactly, a risk-off cascade. Investors get scared, they see their tech portfolio bleeding, and they sell everything, including their winning positions in metals, just to raise cash. So they sell the silver to cover losses in tech. Got it. Okay, number 4.
Just overbought conditions. Technically speaking, if you look at the charts, the RSI gold and silver were at historical overbought levels. They were screaming for a correction. Markets need to flush out the weak hands.
And finally, number 5.
Technical unwinding. There was no war, no surprise Fed policy shift. This wasn't fundamental news. This was just pure technical capitulation where the algorithms all decided it was time to sell at the same time.
So just to recap, we have leverage blowing up, massive profit taking, a tech stock crash, overbought charts, and technical selling, all at once.
Maximum pressure.
And here's what I think is the most important part of this whole deep dive. All 5 of those bearish things hit the market with everything they had. And what did silver do?
It turned green.
That's the part I just can't get over. In 2011 or 2020, that combination would have sent silver down for 6 months. It proves that the underlying physical demand is just incredibly robust. The paper market threw a maximum bearish confluence at the price, and the physical market just absorbed it in a few hours.
It wasn't just silver either. Gold had a crazy ride too.
Oh, absolutely. Gold dumped 8.2% in that crash. That erased $3.1 trillion in market cap.
$3 trillion just evaporated.
And then, in the same day, it pumped 5.2% and added 1.9 trillion of that back.
We're talking about trillions of dollars sloshing around like it's a penny stock.
A $40 trillion asset class moving like a meme coin. It just shows you how fragile this whole pricing mechanism has become.
So the market's broken, the volatility is insane, physical supply is drying up.
Yeah.
What are the big banks saying about all this? I mean, usually they're the ones telling us to stay calm and just buy index funds.
That narrative has shifted dramatically. The institutional giants are finally chasing the physical market reality. They're revising their price targets upward, and they're doing it fast.
What kind of numbers are we seeing?
Goldman Sachs just moved their target to $5,400 for gold. Deutsche Bank is at $6,000.
And JP Morgan.
This is the big one. JP Morgan is now forecasting gold to hit $8,000 to $8,500.
$8,000. Wow. That's a massive number. What's their logic? Are they calling for hyperinflation?
It's actually simpler than that. It's really just an allocation math problem. They're predicting a shift in portfolio allocation. They see private investors increasing their allocation to gold from roughly 3% of their portfolios to about 4.6%.
That sounds like a small shift, just
Yeah.
1.6%.
It sounds small, but when you apply that percentage to global capital pension funds, sovereign wealth funds, that 1.6% represents a massive wall of money.
Trillions of dollars.
Trillions of dollars, all trying to get into a market where the physical supply is already squeezed. The price has to go vertical to accommodate that.
But what about the banks themselves? We always hear about the bullion banks and their short positions. Are they in trouble here?
They are in a very serious predicament. The bullion banks, the big players who trade these contracts, have massive short positions. They're betting the price goes down.
So when the price goes up,
They lose billions. They are seriously underwater. We've seen 2 separate $15 raids on silver this week alone. That looks like a desperate attempt to drive prices down so they can cover those shorts cheaply.
but both raids failed. The price bounced right back.
Exactly. They are trying to push a beach ball underwater and it just keeps popping back up and hitting them in the face. They're desperate and the market knows it.
This sounds like the setup for a massive short squeeze.
It has all the ingredients. If they're forced to cover into a rising market buying back at any price, it just acts like rocket fuel.
Okay, but before we get too carried away with the moonshot talk, we need to be responsible. This isn't a winning lottery ticket. There are huge risks here.
Absolutely. And we need to be very clear about this. The volatility we just described, it cuts both ways.
Right. A $15 swing up is great if you're holding. A $15 swing down, not so much.
If you are trading on margin, if you're using leverage, this environment is a meat grinder. An intraday swing of $15 can wipe out your entire account in minutes. You could be right on the direction long term and still get liquidated.
So don't bet the farm on leveraged products.
Exactly. The trader gets absolutely wrecked here. The holder, The person who owns the physical asset without leverage is the one who benefits from the structural shift.
What about the broader economy? You mentioned the risk-off drag from Microsoft.
Yeah.
Is there a scenario where everything just crashes?
Yes, that's the liquidity crisis risk. If we see a hard recession or if the stock market really crashes hard like a 2008 or a March 2020, investors panic.
And they sell everything.
They sell everything to raise cash. They sell their winners to pay for their losers.
So gold and silver could get sold off just because people need dollars to pay their bills or their margin calls.
Precisely. In a real liquidity crunch, correlations go to 1. Everything goes down together, at least initially. Metals are usually the first to recover, but that initial drop can be terrifying.
So buckle up. It's not going to be a smooth ride.
Not at all.
Okay, let's wrap this up. We've covered a lot of ground today. What are the key takeaways for everyone listening?
I think there are 3 main points to lock in. Number 1, the old paper dump strategy is dead. The market proved yesterday that physical demand, specifically from Asia, can absorb a massive sell-off in just a few hours.
Which is a huge shift in market mechanics.
Huge. Number 2, the physical plumbing is seizing up. We have refineries backed up, coin shops running out of cash, and now reports of government mints shutting down. The supply chain is fracturing under the pressure.
And number 3,
The institutions are finally capitulating. Big banks like JP Morgan are revising their targets drastically upward to catch up with reality. They're finally acknowledging that a new regime is here.
it really feels like we're living through a major transition point.
We are. And I want to leave you with one final thought, this unresolved tension that you should be watching.
What's that?
The Shanghai Premium. We talked about it being $25. It can't stay there. It is mathematically impossible for that kind of gap to exist forever. We are watching a giant game of chicken.
Between the physical reality in the East and the paper markets in the West.
And someone has to blink. How many more raids can they try? How long can the West pretend the price is $116 when Shanghai says it's $141? At some point, the Western pricing mechanism just breaks.
Or loses all credibility.
Exactly.
So that's the real signal to watch. Don't just watch the spot price. Watch the spread.
The spread is the truth.
Well, there you have it. A $15 crash, a miraculous recovery, and a market that is fundamentally changing right before our eyes. Stay curious, stay informed, and thanks for listening to The Deep Dive.
See you next time.